Today, I want to discuss why investments usually perform better than investors do. What I mean by that is that investments like stocks, bonds, mutual funds, things like that investors sink their hard-earned money into seem not to perform as well for the investor as the investment performs overall. Now, why is that? Now, I'm going to get into that in a couple of minutes, but I want to talk to you about this first. When I was a teenager, I thought the only way I could make money was to earn it and put it away in a savings account. I never thought about the interest it could generate or the growth that it could build up. I thought all you did was put the money in. Then when you got old, you take the money out until it was all gone, or you died, whichever came first. I never got the first minute of financial training in school, even all the way through high school. Maybe you had much the same experience in school. So you got out of high school or you got out of college and you went to work making a living and being an adult, but you still had no financial training. Over the years, though, I learned that I didn't have to make all the money that would show up in my life. My money could also make money. But it didn't seem that much to me because I thought in 1 year increments. If my $1,000 made 3% a year, whoop-doo, big deal. I just made $30. So what? That, though, was before I learned about the time value of money. The time value of money. Now, that phrase doesn't sound very powerful, does it? But it is once you harness the power of it and make it work for you. Now, let me explain a little bit. When you understand the time value of money, you're not thinking about the $30 your interest account made this year. You think about what it can make over many years. Let's say that my $1,000 made 3% or $30 in a year. But instead of taking that $30 and buying lunch one day, I plow it back into that account. Now I have $1,030 making 3%. I know $30 at 3% only makes about 90 cents the next year. But it's not just 90 cents. That account is now worth $1,060.90. Again, not a lot of money, but it's building. And in 10 years, that account has grown to $1,344. And in 20 years, it's worth $1,860. And that's just at 3%. What if you could make 6% on your savings? After 20 years, your account wouldn't be worth the $1,860 like it would at 3%. It would be worth $3,207. So at 3%, your $1,000 made you an extra $806. But at 6%, your $1,000 would have made you an extra $2,207. Now, a normal person would think that if you double the interest rate, you make twice the money, right? But that's not really how it works. It's much better than that. That's why the time value of money is so important, and so important to learn while you're young. Now that you know how important the time value of money is, let's kick it up a notch. Most people who are saving for their retirement don't do it in interest-bearing accounts. They invest where they know the returns have been better over the long term, and that is the equities market, like in stocks, bonds, and mutual funds. However, investing in these investments don't offer you a smooth ride like you get with an interest-bearing account, because, as you probably already know, the stock market does go down from time to time. And that frightens people. That's why it's so important to keep our eye on the long term. But so many of us just can't do that. The market goes down for a few days and we just want to jump ship. We are trained to think in a linear fashion. If the market is going up right now, it will continue to go up. If it's going down, it must be in a death spiral, and I need to sell out right now. But history tells us that the stock market doesn't just go down all the way. At least it never has. Looking at it on a daily basis, the stock market has gone up, then down, then up again, thousands of times. But there is one thing the stock market has never, ever done, and that's go down and stay down. Since the start of the stock market in the 1700s, there has never been a time that the stock market as a whole didn't recover and go on to new heights. But we as humans seem to not ever learn that lesson. We jump out after the market goes down and we don't reinvest until it has gone back up. And that's why a Vanguard Group study found that investors that have a financial advisor who is a fiduciary average about an extra 3% per year after all costs over do-it-yourself investors. And that is something that would be really, really good to think about. I'm Noel Swain, CFP, and that's the Provest Short Take for today.